And hello again. This is the Beating the Market YouTube channel. I'm Scott Welsh, and we're at the tail end of a little series that we've done on trading for a living, right? We know why people go to YouTube. Yes, for entertainment, yes, but also to learn stuff. So we've done a four-part series. This is part four of how to trade for a living. If you went to YouTube and typed in the search bar how to trade for a living, hopefully you found me, and hopefully this has been helpful for you. If this is the first time you're seeing it, of course, again, this is part four. Go back to part three, part two, and part one, but not in that order, of course. Do it one, two, three. I mean, that just makes sense. But it's also on my playlist on my channel, so you can just go back to video one and watch it all the way through. Got it? All right, this is part four. Moving on. Three things we're going to learn in part four today. One is futures trading might be a great option if you're going to consider trading for a living. Well, if it's a great option, why is it a great option? Well, we're going to talk about that too. And then if we do like futures, we're going to talk about what it would look like if you decided to be a trader for your living and do it on a futures contract. So let's get started. Well, why futures? Last week we talked about stocks, and everybody knows stocks. So, what's so great about futures? What's the difference? Well, there are a few advantages to futures, but here's the biggest one: leverage, right? I spelled it out for you there on the screen. Leverage is the biggest advantage. And I know that people say that leverage is a bad thing. And I know that leverage has caused financial disasters. Leverage caused 2008 meltdown. Leverage caused the Great Depression. Leverage causes companies to go bankrupt. I get all that. But leverage in responsible hands is a good thing. It is a tool. It allows us to make more money. As long as you don't go crazy with leverage, it is a good thing. And I want it. And I don't want the regulators to take it from me. Stocks are regulated. Forex now is very regulated, more so than when I started. Futures still offers us a lot of leverage. So if we're responsible, that's a good thing. That means that we can make more per trade, and that means that we can trade less. Right? There's an advantage if we can get in the market and take a trade and make a bunch of money. We don't have to continue to do it over and over and over again. And that might be something that appeals to you if you want to trade for a living. So that's the biggest reason. Other reasons that futures are very transparent. They're very regulated as far as the back office stuff, as far as clearing trades. There's no dark pools, no funny business as far as buying and selling. It's very, very transparent, probably the most transparent. So maybe you like that. It's also very trendy, not hip, but futures tend to trend very nicely. So if we have a trend, if we have leverage, well, that is something that can really help us. And it's a real instrument. You can buy a futures contract, and if you're so inclined, you could have stuff delivered to your door. You could have some soybeans delivered or orange juice or something. I don't know. But it is a real instrument, unlike cryptos, which are just a bunch of data mining backed by nothing, right? A lot of articles about that as a negative on cryptos, a lot of positive to cryptos, but it's not a real thing. Like there's nowhere to pick up a crypto and put it in your pocket, really, right? So futures is not that. It's transparent, it's a real thing, and maybe that makes you feel better considering you're putting your whole financial future on futures. That's funny. Here's a picture of what we're going to talk about today. We're going to talk about the E-mini, which the futures contract is at ES, as in Sam. And here's a picture of a bunch of winning trades. Of course, winning trades make me feel good, so I showed them. But this is actually the most recent screenshot of this particular trading system. You can see that's 2018 here, and I'm talking to you in 2018. The cyan lines are winning trades. Our red line would be a losing trade. You can see it's winner, winner, winner all over the place, right? So that's exciting. And that's something, a system like this is something that hopefully we could help us put money in our bank account and then use that for our expenses. So there's a picture of what it would look like to trade a system like this. So what are the advantages? Well, with this particular system? Well, with this experiment, and again, this is just an experiment to get you started. Yes, it's an actual robot that I built, but I don't trade it. This is just hypothetical, just experimental. Hopefully will lead to something exciting for you or a further thought experiment or whatever. But this is not something that I have in the market. So keep that in mind. It's all hypothetical. We're just talking about what it would look like to trade for a living, right? Well, first, the E-mini, what is it? It is the entire stock market. It's the S&P 500. It approximates that, right? So the E-mini is the stock market. What do we know about the stock market? It's a long side bias. The stock market has a bias going up. It tends to go up over time. That's why index funds work, because they buy the market and they go up over time. But this is an index fund, but with leverage. Ha ha ha. So it's a little bit better for our pocketbooks. Also, we're going for a high win percentage in this particular system because why? When trading for a living, it's nice to win a lot. Money goes into our account, feels like we can pay our bills on time. But basically, this particular trading system is like a buy and hold trading system. It's like you're buying the market and holding it, except we do have an emergency stop. So there is an end to all this. So this system is trying to win almost all the trades, but it has an emergency stop. You're not the victim if the market goes super low or super crazy. In this type of system, there is a shutoff valve. All right, so let's take a look at the report. I have it over on my TradeStation. Here is an annual report. This is something that we would consider for trading for a living. This is from the year 2000 to 2018, and this is using a bunch of contracts. This is using 10, I believe. I can double check that for you, but first let's check it out. As you can see, there's only one losing year, and that would stink, right? To trade for a year and actually have our account go down. We still have to pay our bills, so that's something to consider when trading for a living. But guess what? Index funds have losing years also. Yeah, I know. Doesn't seem like it, does it? The market never goes down. Oh, yes, it does. If you're trading for a living, you must be ready for a potential losing year. How are you ready for that? Well, you have extra money when you start. You have a buffer built in. So you get the minimum amount that you can trade and then have a backup plan or a little bit extra money on the side so you can still pay your bills even though you had some losing trades. You can see this is on a daily chart, so there aren't that many trades per year. Haha, that's that bang for the buck we talked about. We don't have to trade very much to make money, right? Look at this. This is a $78,000 year. If our expenses are less than that, then we've not only paid our expenses, but we have money left over. Well, this is only a $10,000 year, so we would have paid some of our expenses, but we'd have to dip into our savings fund, our buffer fund. Get it? This one was 96,000. So let's just say that our expenses for the year are 30,000. A trading system like this has a great year and makes us 96,000, right? Well, that pays our bills like 3 years ahead of time. You see? So we would have a surplus in this year in our trading account so that when this happens, that wouldn't make any difference. We're still ahead of the game. And that's how it works, and that's how you have to picture it. If your trading account, let's say you needed $20,000 a year, well, this would have paid for it, but this deficit would have cut into it, but we would have had some built up portfolio equity in the previous years. But always assume that this is going to happen right up front and have some buffer money on the side, okay? But there's an example, and here's a trading account. Over this time period, it made $652,000. The maximum drawdown was 81,000. So I'm thinking that this is maybe $100,000, $200,000 trading account. Higher if this drawdown needs to be lower for you. We're just spitballing here, just having an experiment. If you're a crazy person, you could do it on a $100,000 trading account. You would see a drawdown, right? Let's go ahead and let's go to the equity curve real quick. You can see that we do have a losing trade here, but overall doesn't really do that poorly. And let's go back to here real quick. I just wanted to show you that. The average losing trade Average losing trade is 52,000. Well, there's only been 2 losers, so that is the losing trade. So yes, you see this as 81,000. That's the max drawdown, but really you would have a $52,000 loss. I know it seems high, but we're just experimenting. And then the next trade it took drew down a little bit before it was an actual winner. So it adds the actual amount of the losing trade and then adds a little drawdown from the next trade. But in truth, this number is a little bit high. The actual loss in your account that you would see would only be when it takes a full emergency loss, which would be 52,000, right? So on a $100,000 account, that's a lot, and that's why you saw that losing year. On a $200,000 account, not so much. On a $300,000 account, even less. So these are all of the thought experiments and all the planning you have to do when you want to trade for a living. But again, you see, when you have these big years, not only do you pay your bills, but you get a surplus in your account and maybe even raise trade size. All right, see where we're going with all this? Anyway, that's the report. Obviously, you saw that there's big money if we win. So thank you, Leverage, even though people hate you. You don't have to trade a lot. And honestly, this is just one instrument, right? You could build a portfolio and do more things if you like. This is just trading one thing and trading for a living, right? It does provide a lot of income for just trading one thing. Interesting, huh? So, what would our lifestyle look like? Well, we've talked about that as far as the financial planning quite a bit, but if you're trading one instrument and you're only trading 3 to 5 times a year, you don't need an office with 10 monitors. You don't need that crazy setup we've talked about in previous videos. It's just one computer. Maybe it's a laptop, right? Just one computer to trade this, to have turned on. If you're trading an automated system, obviously you need it turned on. If you're doing this manually, which clearly you could do in a system like this, then you just need one computer, set up your trades, take out your profit target, set up your emergency stop if you need it, and then basically just let it roll. Oh, can I show you one more thing real quick? 96% win rate on this. I told you it was buy and hold. So that's why I said when you set up orders just previously a few seconds ago, you would set up your orders and then basically you just look to see when your trade won, right? When you have a large emergency stop, like I said, it's like buying and holding, right? It hardly ever hits that stop if you set it far enough away. So you could design a system where the emergency stop is very far away. You get a bunch of winners, you make a bunch of money. This is the type of system that this is and something I want you to consider. So no 10 monitors, no stress, right? These trades take a while and are easy to set up and you can see them coming a mile away. You don't have to worry about any fundamentals with a trading system. Trading a futures contract, you can read the news if you want, but you don't need any fundamentals. You're just putting in your trades manually or trading the system automatedly. It's just super easy, right? We're not talking about a lifestyle where you need to work a lot. Keep in mind, as you saw on the screen, there was only one losing year in a system like this. The stock market has had 2 in the same time period in the last, what is that, almost 20 years. So the stock market does this not once but twice, and you make less money. So an index fund, you still have to do losing years. Oh, and you get less money for more losing years. Just saying, maybe that's not the best thing in the world. And I mean, with this particular system, if you're trading the E-mini, if you do like fundamentals, clearly you can follow along and see what's happening. Stock market is down today on CNBC or wherever, right? Then you would reflect that probably, or you'd see that reflected on your chart. So you can follow along and you know how things are going. If things are going well and great economic reports, you can pretty much bank on you'll be making winning trades, okay? Now, just a little bit of detail on what I did. This is the E-mini. I've said that 100 times. This particular system uses the Heron methodology, which means you determine the trend and get in on a pullback, okay? This, though, goes for big profit targets, or at least profit targets that make a lot of money, and as I mentioned, a huge emergency stop loss. So if you want to create your own system, go with the trend. It's not counter trend. Whatever you do to determine the trend, go with it in that direction. In this case, we're trying to only go long. Then go for big targets and put in a nice big emergency stop that doesn't get hit very much. This used one contract per 10,000 in a trading account. Like I said, the example we used was 10 contracts, right? 10 contracts. Let's double check that for you. Right, max share contracts held, 10. Ha, I was right. I wouldn't lie to you. So 10 gets you that 652,000. Obviously, if you just use a smaller account, you would get less money. And then, even though we did look at the report a little bit, I summed it up for you on the screen. How nice of me. 2002 is actually when the first trade was taken, but the testing period started in 2000. But because of the look back bars, it's boring. The first trade happened in 2002, all right, but the testing period started in 2000 or 2000 even. So 2002 to 2018, this I calculated for you had a compound annual growth rate of about 36% per year. Fantastic. And that's, of course, if you compounded as your account went up. The max drawdown was close to close, and we talked about that, was about 53%. If you used a $100,000 account, that's a lot. Again, you could use more, but from close to close, the maximum trade loss was 53,000. Again, you might see some drawdown in the next trade, but the actual loss in your account was about 53%. And the win rate, as I showed you, was 96% with trading costs built in. I always build in trading costs, commission spread, whatever the case may be. I always build that in accurately, so my numbers are accurate. So if we go back to the example in this series and we had about a $5,000 per month expenses, for this system, I said on 100,000, I would bump that up probably to 200,000. Maybe I would raise those contracts up to 15 or so. Or, I mean, leaving it at 10 gets pretty darn close to that, right? But this would clearly cover the 5,000 per month expenses. If you use a $200,000 account, you could use 10. You could use 20 if you're aggressive. 20 would surely do it. 15 should get you what you need. But anyway, that is the calculation you'd have to make. You'd have to take, well, what is it per month? And how many contracts do I have to spend? Regardless, if you went to 100,000 or 200,000 or 300,000, this is way less than the 600,000 you'd need for a stock system or an index fund, right? So the advantage on top of all the advantages we've already talked about is we would need less money in our trading account to trade this particular system or a system like this for a living. Bottom line, a lot of information, but this is trading. It's not passive investing. It's not an index fund. We are trading, but we're basically a buy and hold investor. The trading is not that often. It can be done manually or in an automated fashion. It's basically buy and hold. We're going to win 96%, but we're a trader. We're not just crossing our fingers and hoping. Problems with that? Yes, it's not a lot of trading, but it's still trading and you have to do the work. The orders have to be in or your trading robot has to be turned on at all times. You cannot miss a trade. Only happens maybe once to 5 times a year, but you can't miss it. So again, that's not a lot of work. It's mere minutes worth of work, really, but you have to be there every time. Obviously, to trade something like this, you'd have to be patient. It's not trading a lot, so meanwhile, your expenses are coming and going, and you're not taking trades. That takes a special type of person. And a system like this, every loss is a huge event. To lose would be a huge hit on the trading account and would be very stressful, and that's not to be taken lightly. That needs to be taken very seriously. In an index fund, your account would be going down, and you would say, oh, there's no end to it. It might go down forever. That would be stressful. The stress in this case is you actually will take a loss. So keep that in mind. And to trade for a living, to make 40, 50, 60,000 a year of trading expenses, be able to be taken out of your account, you're going to have to see some big numbers, right? You're going to have to, you'll be up and down on your trading screen, big numbers, and you need to be really, really ready for that, right? But it's possible. If you want to see any other robots that I do or anything about me whatsoever, you can see courses on Kajabi next. If you want a newsletter, I talked about this particular system this week in the Wednesday newsletter. Go to scottwelsh.me and just sign up for the newsletter. That's a lot of info, but it's a lot of fun. I love talking about trading for a living, and I hope you enjoyed it and found something useful. This might be the end of the Trade for a Living series. You'll know it when the next video comes out. Subscribe to my YouTube channel and you'll always get it. But again, I hope it was helpful, and I'll be back next week. Bye for now.